Hello, hello, hello. Welcome. For those of you who are watching me for the very first time, my name is James Ambroise, and on this channel we cover how to pay off debt faster than any other debt repayment method out there. We cover basic bookkeeping and accounting for someone who just started out a small business. We cover basic personal income tax to include a Schedule C, Schedule E, depreciation. I am also the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Real quick about my credentials. I have been or am a bookkeeper and accountant, QuickBooks Pro advisor, senior tax advisor, residential real estate investor, residential property manager, financial coach. And as always, before we get started with what's on the board, please allow me to shout out the name Jesus, my Lord, my God, my Creator. Thank you. All right, America, on the board we have this hypothetical scenario of somebody who filled out one of my Microsoft Excel worksheets, and the person provided me with these figures. For that, this person has a pen-fed HELOC and a mortgage, and a traditional mortgage. The original loan amount, the credit limit, $25,000. The APR, 5%. Balance owed, 0. Monthly payments charged, $0. Availability, America, remember from prior lesson that the availability is the relationship between the credit limit and the balance owed. That relationship calls for a subtraction operation, 25,000 minus $0. That's how we arrive at 25,000. Credit utilization is the relationship between the monthly payments charged and the balance owed. That relationship calls for a division operation, $0 divided by 0. That's how we arrive at 0%. Okay? Payment rates charged. Payment rates charged is the relationship between the monthly payments charged and the balance owed. That relationship calls for a division operation, 0 divided by 0. That's how we arrive at 0%. Okay? Now, on the pen-fed HELOC, this pen-fed HELOC is charging interest only. Okay? Because remember, America, from prior lesson, these HELOCs, they are not always interest only. Some of them, some lenders, some creditor charges principal and interest, even on an HELOC. Okay? But this particular pen-fed HELOC only charges interest. Okay? And it's a 10-year draw. And right now, we're still inside the draw period. Okay? Now, for the mortgage, it's a 30-year fix, and this particular lender does not require any escrow account, so does not require any impound account for taxes and insurance. Okay? So this figure, $843.21, only covers principal and interest. Okay? Now, we're doing a scenario for a financial coach. The income that was provided was $5,169. The expense, $4,769. The debt, $200,000. The debt, America, that's when you add all these balances. $0 plus $200,000. That's how we arrive at $200,000. Okay? And cash flow, $400. America, remember from prior lesson that cash flow is the relationship between the income and the expense. That relationship calls for a subtraction operation, $5,169 minus $4,769. That's how we arrive at $400 in cash flow. Okay? Now, financial coach, the question he asked me was, James, can you please tell me why I should not send a chunk payment of $20,000, okay, to the mortgage when I would be exchanging $1,000 in interest cost for $25,821.19 in interest savings on the mortgage. America, we're going to kind of take it one by one. And again, financial coach, the question he asked me was, James, please tell me why I should not send a chunk payment of 20 grand. So if we take a look at the HELOC, the balance is 0. So there's room for them to make a chunk from the HELOC. And the chunk payment is talking about the amount is 20 grand. Okay? So I would be exchanging $1,000. So what it's talking about is that $1,000, because when you do 20, because the new balance now in the PenFed HELOC gonna become 20,000 times the HELOC is at 5%. So times 5%, that's how we arrive at $1,000. Okay. But let's run it one more time just for good measure. If they make a chunk payment from the HELOC of 20 grand, so 20,000, times 5% in interest that they are charging on an HELOC. So that is how he arrives at that 1,000. Okay. And interest cost. Okay. So his interest cost for the year gonna be $1,000. Okay. But for doing that kind of exchange, his cost only gonna be $1,000 according to him. And his interest saving on the mortgage gonna be $25,821. Okay? And how you arrive at that number is if you were to keep the mortgage for 30 years, the interest would have been $103,554.92. But once you make the chunk payment to the mortgage, okay? The interest is going to get reduced from $103,554 to $77,733.73. So when you do 103,554.92 minus $77,733.33. That's how you arrive at this $25,821.19 that he's talking about. So $25,819, which is the difference between the interest you would have ended up paying versus the actual interest, okay, for making that chunk payment. So it goes from 103 to 77, a difference of 25,000. Okay, so you'll be charging, according to him, you'll be charging the HELOC 20 grand. That 20 grand only gonna cost them $1,000 for the year. Meanwhile, on the mortgage, he's saving $25,821. So to him, that's a good exchange. To lose $1,000 on a HELOC, as far as interest cost, okay? But he has a interest savings of $25,821.19. So losing $1,000 to save $25,821, according to him, that's a good exchange. Okay? All right. Now, we're gonna get to all of that a little later in the lesson. America, just like I mentioned to you guys from past lesson, there are a few lessons that I need to cover. I need to cover at least 3 lessons, at least 3 more lessons. There might be more, but at least these 3. Event priority, which I talked about in the past. Event priority, again, is an event that takes priority or takes precedence over everything else, okay? Consolidation of due dates. That's another lesson that I need to cover. And 3 alternative accounts simultaneously. That's when you're having movement of income and movement of expenses, not just in one or two, but in three separate alternative accounts at the same time. Okay? These three lessons, at least three more lessons, these three more lessons gonna come in the future. So bear with me, America, because just like I mentioned from the past lesson, I want you guys to get the foundation first before I start introducing more advanced top items like event priority, consolidation of due dates, and three alternative accounts simultaneously. Okay? All right, America. Today we're doing case study number 12, and today's date is January 11th, 2025. Okay? And again, folks, financial coach, the question that he posed to me was, James, please tell me why I should not send a chunk payment of $20K from the HELOC to the mortgage, okay, when I would be exchanging $1,000 in interest cost for $25,821 in interest savings on the mortgage. Okay? That was the question. All right, America. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to start with the exercise. All right, America. Again, question posed to me from the financial coach was, James, please tell me why I should not send a chunk payment of $20,000 from the HELOC to the mortgage when I would be exchanging $1,000 in interest costs from the HELOC for a savings of $25,821 on the mortgage, which is the difference between 103,554 and 77,733. Okay. All right. America, let's run the scenario on the board with what he's talking about. Okay. So, a chunk payment of $20K. Okay. All right. So let's take care of that first. From the HELOC. So so now we have PenFed HELOC. Credit limit $25,000. The APR on the PenFed HELOC 5%. Balance owed. Now remember, financial coach wants to make a chunk payment to the mortgage. So for that reason, the balance in the HELOC gonna get increased by the chunk payment, and the chunk payment was $20K. Okay, so PenFed gonna get increased by $20,000. So 0 plus $20,000 is $20,000. Okay, the monthly payments charged. Most of these lenders, these creditors, charges average daily balance with compounding, including new transactions, and the way we're going to arrive at the monthly payment charge, you're going to take that figure times the daily periodic rate times the number of days in a cycle. And the number of days in a cycle could be 28 days, 29 days, 30 days, 31 days. Okay? Since this financial coach talking about chunking, so obviously I'm assuming that that belongs to Velocity Banking Group, okay? Because they use the term chunk, okay? And these folks over at Velocity Banking Group, they always use 30 days, and the cycle is always 30 days, it seems, okay? But remember, America, the cycle could be 28, 29, 30, and 31. Doesn't always have to be 30 days, okay? All right, so for monthly payments charged, okay, let's assume we're doing this transaction in the middle of the cycle. So on day one, the PenFed HELOC got increased by 20,000, okay? So it's an average daily with compounding, including new transaction. From day one, it was 20,000, and we did not have any other transactions since day one, okay? So which means it's still 20,000, but since they're using average daily balance with compounding, that 20,000 interest is going to be added to the 20,000 on top of interest, for lack of better terms, okay? So let's figure out what the monthly payments charge would be, okay? So let me open up my proprietary formula, Excel formula for average daily balance with compounding, including new transaction. Okay. 5% HELOC, the beginning balance would be 20,000, okay? And we did not have any new transactions, assuming we did not. So which means that the monthly interest charge for the cycle would be $82.37. Okay. Okay. And again, they're using average daily balance with compounding, including new transaction. Most of lenders, most of creditors. Now, if they were using, for lack of better terms, a simplified type formula, not a simple formula, but a simplified type formula, it would have been 20,000 times 5% divided by 12. Let's run that one real quick. So 20,000 times 5% divided by 12, it would have been 83.33, okay? But since they're using a different type of formula, instead of 83.33, it's only 82.37, okay? All right, the availability will be credit limit minus balance owed, so 25,000 minus 20,000 is 5,000. Okay. Credit utilization is balance owed divided by credit limit, so 20,000 divided by 25 should be 80%, so 80%. Okay. And payment risk charge is monthly payments charge divided by balance owed. So 82.37 divided by 20,000. Okay, that's how we arrive at 0.41%. Okay. All right. That was the mortgage. And again, send a chunk payment of 20K to the mortgage, okay? So the PenFed HELOC gonna get increased by 20K, and the mortgage gonna get decreased by 20K, okay? So now let's take out the mortgage. $200,000, 3%. Balance owed, and again, financial coach wants to send a chunk payment to the mortgage. So mortgage is going to get decreased from 200,000 to 180. Because 200,000 minus 20,000, that's how we arrive at 120. Okay. Monthly payments charge, America, because it is a mortgage, it is an installment credit account. Okay. The monthly payment charge typically will stay the same. So $843.21 will stay $843.21. Okay? Because for a mortgage that charges principal and interest, even though you're doing transaction inside a mortgage, okay, the monthly payment charge is still gonna stay the same until you completely wipe out the mortgage. Okay? So throughout the duration, throughout the life of the loan, that monthly payment charge will stay the same, $843.21 on a 30-year fixed mortgage. Okay. Availability, well, it's a mortgage, it's an installment credit account, so the availability doesn't matter. Credit utilization doesn't matter. Okay, we could put it on the board, but it's an installment credit account. So, and payment rate charge is monthly payment charge divided by balance owed. Just run it just for good measure. $843.21 divided by 180,000. Okay. So now we are at 0.47%. Okay. All right, America. And again, so far, financial coach talking about chunking from the HELOC to the mortgage. Okay? Sending a large payment from the HELOC to the mortgage. Balance on the HELOC gonna get increased by 20,000. Balance on the mortgage gonna get decreased by 20,000. So the total is still $200. 0 plus 200, 200,000. 20,000 plus 180,000, still 200,000. Okay? All we've done, we're just relocating some balance from one place to another. That's all we've done. Okay. Now, America, let's take a look at the total interest over the life of the loan, which is this figure, $103,000, $103,554.92. Okay? Because these folks over at Velocity Banking Group, well, some of them, okay. Well, so far I haven't come across one that did it right, but hey, maybe one of them did it right and I just haven't watched the video yet. I don't know. Okay. But these folks over at Velocity Banking Group, some of them do not know how to properly read the amortization schedule. And we're going to go over that. Okay? Let's assume, America, well, the interest for the life of the loan was $103,554.92. So on 200 grand, okay, over 30 years, this is the mortgage now. The total interest, if you were to keep the loan all the way through 30 years, the total interest you'll be paying would have been $103,554.92. And then when I was doing, let's run it one more time, making sure I did not make any mistake on my numbers. So let me go to a different calculator online. 200,000 over 30 years at 3%. Sure enough, the total interest over the life of the loan, 103,554.92. Okay, due to rounding, they have 90, but it should be 92. Now, let's assume it was a $20,000 loan. Okay. Because that's how much the chunk payment was. Okay. So if we're breaking down over 30 years, most lenders would even do a loan for 20K because some of them got their base minimum. Some of them probably like 75,000 or 100,000. But let's assume that this one was not in first lien position. Okay. But for second lien, they might make an exceptions. And you got some lenders, once in a blue moon, they'll allow you to do a piggyback type loan to where the amount might be a little lower than the base amount, okay? But in any event, let's go over 20,000, 30 years, okay? To see how much the total interest would have been if it was 20,000, okay? So let me go online again. So 20,000, 30 years, 3%. The total interest would have been 10,000. $355.49. Okay. Let's do one more. Let's pretend it was a mortgage 500,000. Again, over 30 years at 3%. Okay. Your total interest over 30 years on 500,000 would have been $258.26. Okay. All right, America. Over 20,000 at 3%. I mean, over 30 years, a mortgage charging 3% interest for 20 grand. The total interest over the life of the loan would have been 10,355. Okay. Over 30 years at 200 grand, the total interest over the life of the loan, 103,554. Mortgage for 500,000 over 30 years, at 3%, the total interest over the life of the loan would have been $258,887.26. The reason why, America, I kind of want to go over this little scenario is because some of the folks over at Velocity Banking Group, they truly do not understand how interest rate works, okay? Or at a minimum, they do not know how to read properly the amortization schedule, okay? This 103,554, $103,554.92, that is the total interest you would have paid over the life of the loan. And the life of the loan, 30 years in this example. So if we break it down on average, 103,554.92 divided by 360 months. Because remember, 30 years, each month has 12, each year has 12 months in it. 0, 2, 0, 3, 2, 6, 3 times 1, 3. So over 30 years, we have 360 months. Okay? So this is the total interest over the life of the loan. So if we were breaking it down to see on average how much the interest would have been. So you would have been 103,554.92 on 200,000 now. 103,554.92 divided by 360. So on average, your total interest, your monthly interest on average would have been $287.65. Okay? So on average. Okay? For the month. Okay? Let's run the one for 20,000. And again, the total interest over the life of the loan, if it was 30 years, okay, in this hypothetical scenario, $10,355.49 divided by 360 months. So 10,355.49 divided by 360. So we have $28.77. On average per month. So let me put per month on average instead. Per month on average. Okay, this one per month on average. Okay? And let's run it for this hypothetical scenario. If it was 500,000 over 30 years, the total interest over the life of the loan would have been 258,000 divided by 360. Okay? So 258,887.26 divided by 360. So this one would have been $719.13. Per month on average. Okay. America. And again, some of the folks over at Velocity Banking Group, they're talking about mortgage like mortgage is or the amortization schedule, like this thing is the boogeyman. I heard watching these YouTube videos, one of them talking about how mortgage has the Latin word mors or mort, which means death. So they try to demonize the mortgage or the amortization schedule. Why? Because they don't fully understand how to properly read the amortization schedule. America, if someone were to tell you that they're willing to lend you 200 grand over 30 years, and all that you have to give them on average is just $287.65 in interest per month. America, if somebody make that kind of offer to me where they're going to give me 200,000 and all I have to give them back on average, 287 bucks, man, I'll tell them, go ahead and sign me up right now. I'll take it. That was for the $200,000 mortgage. Now let's talk about the $20,000 one. If someone were to tell you, America, hey, I'm gonna lend you 20 grand, all you have to pay back per month on average is 28 bucks. America, you would spend a second, you ask them to sign you up right now. And for 500,000, same thing. If somebody want to lend you $500,000, and all you have to pay on back in interest per month is 719 bucks. That's all the interest you have to give them per month. Okay? You rush in and ask them to sign you up for it. You'll take it in a heartbeat. Okay? The reason why, again, I want to go over this little exercise is because some of the folks over at Velocity Banking Group, they do not know how to properly read or how to properly analyze the amortization schedule. You're going to let me lend 20,000, all I have to pay you back is 28 bucks per month on average. You're going to let me borrow 200,000, all I have to pay you back is 287 bucks per month on average. Or you're willing to let me borrow 500 grand, all I have to pay you back 719 bucks per month on average. Sign me up right now. Don't even allow a second to go by. Okay? These folks, they are looking at the total interest because they do not know how to properly read the amortization schedule. That number, that big number, got them confused. 103,554.92. 103,554.92. But that figure, America, is over 30 years or over 360 months, which is equivalent to $287.65 per month on average. America, the mortgage or the amortization schedule is not the boogeyman. Okay? A mortgage, America, is the cheapest form of lending. The absolute cheapest form of lending so far. Okay? Of course, Congress might change something or the banks might change something. But remember that the interest rate on a mortgage, America, is typically or generally lower or considerably lower than the interest rate, say, on an HELOC or the interest rate on a credit card. Because remember, the interest rate on the HELOC right now, they're probably going 8.25%, 9, 10, 11, 12. Okay? The credit cards, maybe 18 if you're lucky, 19, 20, all the way to, some of them charging as high as 30. I've seen 133. I overheard somebody talking about 135. Meanwhile, the interest rate on the mortgage is like this one, 3%. Okay? Look at the interest on the mortgage. 3%. Look at the interest on these other items. For HELOC, 8.25 and up. For a credit card, 18% and up. If you're lucky. Okay? And again, folks, the mortgage is one of the cheapest form of lending right now. Okay? These folks over at Velocity Banking Group talking about the mortgage like it's some kind of boogeyman. Why? Because they simply do not know how to properly analyze the amortization schedule. I'm talking about the group that likes to brag about getting rid of a mortgage inside 5 to 7 years, specifically that group, okay? Overall, every single one of them really, but specifically that one group, okay, since we're talking about an amortization schedule, all right? All right, America, before we answer the rest of his concern, of his questions, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Now let's go over the amortization schedule that I put on the board. This right here, America, is an amortization schedule. Amortization schedule. For years, I have year 1, year 2, all the way to 30 years. Because a mortgage, this particular mortgage is a 30-year fix. Okay? So in the year column, 1 all the way to 30 years. In the interest column, for year 1, the interest you would have paid $5,942.90. For year 2, $5,815.89. That's for 12 months now. Year 1, year 2. Okay? And principal for year 1, $4,175.60. Okay? Principal for year 2, $4,302.61. So over the life of the loan, when you add all the interest from year 1, year 2, year 3, year 4, year 5, all the way to year 30, the total interest, $103,554.92. That's over the life of the loan. If you did not do anything, if you were just making the regular principal and interest payment, which is $843.21. Okay? So over the life of the loan, again, your total interest would have been $103,554.92. Now, since they've made the chunk payment to the mortgage, remember they reduced the balance on the mortgage from $200,000 to $180,000. Okay? That chunk payment changes things a little bit. What changes? The interest in year 1 is now $5,385.87. The principal in year 1, remember, you send an extra payment of 20 grand, okay? Plus this additional payment, okay? Remember, this 843.21 is comprised of both principal and interest. So when you add all the principal for 12 months plus the 20,000, so you're gonna have a total principal payment for the year of $24,732.53. Okay? And for year 2, $5,190 principal. For year 2, $4,927.86. When you add all the interest from year 1, year 2, year 3, year 4, year 5, year 6, year 7. Now, because they make this chunk payment, if that's all they've done, okay, they didn't do anything else. They just make that one chunk payment. In year 25 and part of year 26, the loan would be paid off. On this one, the loan would be paid off in 30 years. On that one, the loan would be paid off somewhere in the 26 years mark. Okay? Okay? So somewhere in the 26-year mark, the loan will be paid off. Okay? And the total interest would have been $77,733.73. Okay? So this is over 30 years. No chunk payment. This is after a chunk payment. So the loan now got reduced from 30 years. So you would ended up paying off the loan in less than 26 years. Okay? So 25 years and some change. Okay? And there's a big difference in the interest. 103,554.92. Now the new interest would have been 77,733. Okay? All right. Now I think I got everybody else on board. Okay? Because I want to bring everybody with me, making sure that everybody understands what we're talking about, okay, with this amortization schedule. Okay? Because again, not everybody has the same level of knowledge. So over 30 years again, this is the total interest. But for making the chunk payment, this would be the total interest. Okay? 77,733. All right. Now, these figures are America 103,554.92. That's if you would have kept the loan over 30 years. If you would have kept the loan over 30 years. Okay? This is just a projection. Okay? Or projected interest cost. Okay? This is just a forecast. Same thing over here, $77,733.73. $77,733.73. Again, that is a projection. Put down on the board. Or a forecast. Okay? So now we're going to do projection versus actual. Okay? And again, folks, right now we're in year 1. We're not even done with year 1, let alone to start talking about year 30. And again, that is just a projection or forecast. Okay? These folks, because they don't fully understand how to properly read the amortization schedule, they're using the forecast amount figure from 30 years, which is 103, 554, 92, like I did earlier, minus the new forecast for making an additional payment. The new forecast now is 77,733.73. And the difference again is 25,821.19. Let me run it one more time. 103, 554.92 minus 77. 103, 554.92 minus 77, 733.73. Sure enough, $25,821.19. Okay. Again, this is a forecast. What we would have been to what it is now. This one is over 30 years. This one more than 25 years. $25 years on this one and 30 years over here. 30 years, 25 years. 25 plus. Okay? Now, again, going back to the question from the financial coach, James, please tell me why I should not send a chunk payment of $20K to the mortgage. There goes the chunk payment, $20K to the mortgage. Okay? 200,000 to 180. When I would be exchanging $1,000, and again, where they arrive at that $1,000, it's 20,000 on the HELOC times 5% equal $1,000. And let me run it one more time. Sure enough, $1,000. So now they are comparing the interest on the HELOC, which would have been $1,000 over 1 year, 5% per year, so over 1 year. And they are comparing the difference between 103 and 77,000, which is 25,825 nights over a long period. Remember, 30 years on this one, 25 plus year on that one. The difference is over 25,821, 19 is over a long time. Let's just put over a long time. These folks, again, they are confused about the amortization schedule. They are comparing America $1,000 in interest cost on the mortgage, so 20 grand again times 5%, that's $1,000. That's over 1 year. They're comparing that interest cost and 25,000 savings over a long time, over multiple years. In essence, America, they are doing apples and oranges. You cannot compare the interest over 1 year, the interest cost over 1 year, with a savings over a long time. And again, that figure, that is from 30 years. 103,554, that's 30 years. That's how much the interest would have been. 77,733, that's over 25 plus years. You cannot compare a cost over 1 year with a cost over 25 years. And not only that, the payment, America, was only 20 grand. The chunk payment. If you send a chunk payment of 20 grand, the chunk payment was only 20 grand. How can you save 25,821 bucks when the chunk payment itself was only 20 grand? So you send a chunk payment 20 grand, but you save more than the chunk payment. So you save more than 20 grand, you save $25,821.19 from one single chunk payment of 20 grand. Folks, the mortgage was only at 3%. To send a chunk payment of 20 grand and that one yields a saving of $25,821, let me run it real quick. So that interest rate on the mortgage would have been, let me run it. Let me see, if you send a chunk payment of 20 grand, but you ended up with a savings of 25,000. Let's run it, 25. Let's see. So far I got over, the interest rate on the mortgage would have been, let me see, over 125%. Let's see, 1005. Okay, let's run it. So 20 grand you would have been 20 grand times 129% interest. Let me run it one more time, making sure I did not make any mistake. 20,000 times 129, 105%. Sure enough, 25,821 bucks. America, if you send a chunk payment of 20 grand, the only time you would have a savings of 25,821 bucks, that means the mortgage, they would have to charge you 129% on the mortgage. These folks, they don't understand how interest rate works. A chunk payment of 20 grand cannot save you 25,000. Because the mortgage was at 3%. You cannot save more than what they're charging you. If they're charging you 3%, you could save 1%, you could save 2%, you could save up to 3% because that's how they're charging you. Okay? You cannot have a savings more than what they're charging you on the item itself. On the mortgage, they're only charging 3%. How can you possibly save $25,821 when your chunk payment was only $20,000? Folks, this is what we call amateur hour. That is what happened when you go on YouTube and trying to get personal finance advice or advice on personal finance. You come across these people, not all of them. Some of them can't even properly read an amortization schedule. Some of them don't even know how interest rate works. They think if they send a chunk payment of 20 grand, that 20 grand chunk payment yield them 25,000. But they fail to realize that these numbers are over a long period. That 103 again, 554, that's over 30 years. This 103,000. This 25,000 is over, this 77,000 is over 25 years. For one, they are comparing apples and oranges. 1,000 in interest cost for chunking to the mortgage. And again, 20,000 times 5% that they're charging on the PenFed HELOC. That would have been $1,000 if they're using the simplified type formula. Okay? Most lenders, by the way, uses an average daily balance with compounding, including new transactions. That would not even be $1,000. Okay? But since they're using a simplified formula from their questions, fine. We accept it. It's just $1,000. Okay? But this is over one single year. These figure out over multiple years. And again, they do not know how to properly read this amortization schedule, so now they're comparing the results over 1 year with the results over multiple years. Apples and oranges. Some of these folks are becoming laughingstock. A 20K chunk payment gonna save you 25,000. You cannot have a savings greater than what they're charging you. They're charging you 3%. On 20K, you would be 20K times 3%. The most you would get charged would have been 600, but let's run it. 20,000 times 3%, the most you would save, I'm sorry, $600. That's the most you would save, okay? But you will never be $600 because as principal comes in, that 20,000 will get reduced. So that 20,000 will not stay constant over a 12-month period to where it will be $60. So it will be less than $60, okay? And then let's find out real quick how much it is for making that chunk payment. On year one, the interest would have been $5,942.90. Now, for making the chunk payment, that 20,000 chunk payment, the interest for year one, so for 12 months, is now $5,385.97. Okay, so let's run it real quick. Should be 55693, but let's run it one more time, making sure I did not make any mistake. 5942.90 minus 5387.97. I have 554.93, but let's run it one more time. 5942.90, 5385. 5942.90 minus 5942.90 minus the new interest charge for the year after the chunk payment, 5385.97. 556.93. 556.93. Okay? So the most you save over 1 year, instead of $600, it's $556.93, which is the difference between what the interest would have been if you did not do the chunk, which was $5,942.90, versus your new interest over 12 months for making the chunk payment, $5,385.97. The difference between those two is your saving, okay? If you didn't do anything, it would have cost you this one. Now, since you did do that chunk, for the year, it only cost you that much in interest. A difference of $556.93. That's all you're saving for making a 20K chunk. You are not saving 25,821. Sending a 20,000 chunk will save you 25,000. This is La La Land. Again, America, kind of be careful when you go on YouTube as to whom you chose to get personal finance advice from, okay? Because again, some of the folks over at Velocity Banking Group, especially that one group that likes to talk about how they could get rid of a mortgage inside 5 to 7 years. These people, man, so far I haven't come across not even one that know what they're doing, okay? But let's give them the benefit of the doubt. Let's say at least there's one. Maybe I haven't watched the video yet, okay? These people, majority of them have no clue how interest rate works. That's why they got you doing this nonsense. Oh, go ahead and get an HELOC in order to facilitate your fight against a mortgage. Get an HELOC so you could pay the mortgage sooner. Okay? A lot of times in America, you're just going backwards. Okay? Because if the interest rate on an HELOC would have been $1,000, imagine I'm getting charged $1,000 so I could save $556.93. And the reason why they want you to do this stupid exchange, this silly exchange I should say, is because they do not know how to properly read the amortization schedule. They're comparing 1 year of interest versus multiple years deriving from the amortization schedule. A 20K chunk gonna yield you $25,000 in savings. That is the silliest thing I ever heard. I send a payment of $20,000, but I receive a savings of $25,000. This mortgage would have to be at 129% in order for me to send a payment of $20 and yield $25. Okay? But the mortgage was only at 3%. And again, folks, you can only save up to what they are charging you. 20 grand, 3%. The most you could save is $600. But again, it's not even going to be $600 because that $20,000 not going to stay constant. As principal start coming in, principal going to keep reducing that $20,000. Okay? So now the interest, that 3% interest is going to be on a lower amount. That is why it's not $600. It is only $556.93. Okay? After the chunk payment. All right? And not only that, this is the true interest for the year. If you didn't do anything, it's only $5,942. But when you did do something, it became $5,385. That's over 12 months, folks. Okay? 12 months. All right? Which means that the monthly savings now, let me put it right here. The monthly savings on the mortgage is only $20,000 since you make a chunk payment times 3% divided by 12. Let's run it. Should be $50, but let's run it one more time. 20,000 times 3% divided by 12. Or you're saving for the month for making that chunk payment to the mortgage. It's just $50. Okay? This is over a year. Okay? This one is over 1 month. $50. Okay? That's all you're saving on the mortgage. Meanwhile, the interest portion on the PIN Fed is $82.37. So, in essence, America, you want to save $50, but you're getting charged $82.37. That's not a good exchange. I'm saving $50, but I'm losing $82. Not a good exchange at all. Okay? So, a 3% HELOC, a 5% HELOC versus a 3% mortgage. Let me write down a little bigger on the board. So a 5% HELOC versus a 3% mortgage. Okay? Don't do it, America. Don't exchange a 3% for a higher 5%. Okay? Don't do it. Because on the HELOC, you're getting charged the interest cost for the month, $82.37. And the savings, that's the interest cost now. Interest cost, $82.37. Okay? But your savings on the mortgage is only $50. Again, 20,000 times 3% divided by 12, $50. That's all you're saving for making a chunk payment to the mortgage. Okay? Again, you'll be saving $50, but you'll be losing $82.37. Okay? Not a good exchange at all. So as you could see, you're going to be going backwards. Do not chunk or try to acquire an HELOC so you could chunk to a mortgage that is at 3%. Okay? These folks, they just blindly saying stuff. They never run the numbers to see, okay, if the scenario will work. They're just blindly saying stuff. Why? Because some of them think that having movement of income and movement of expenses inside the HELOC, okay, gonna cure everything. Okay? Having movements of income and movement of expenses, America, inside the HELOC, he helps, but he doesn't cure anything at all. Okay? So that would be the next argument. So they're gonna say, well, it is true, James, that on the mortgage, I'm being charged, I'm saving $50 while I'm being charged on the HELOC $82.37. But again, I'm going to have movement of income and movement of expenses in the HELOC. Okay, well, let's run it real quick, America. Let's run that scenario real quick. To see what happened when you have movements of income and movements of expenses inside the HELOC. Okay. Remember, the income was $5,169. The expenses, $4,769. Debt, $200,000. Cash flow was only $400. Okay. If we mimic what some of the folks over at Velocity Bank is doing, current balance $20,000. Okay, of the HELOC. Okay. The interest rate 5%. Okay. Income goes in. There goes the income, $5,169. Expenses go up. America, the expense is supposed to be $400. Just like I've done from the past lesson, past case study, I reduces the expense from $4,769. I reduce the expense all the way to zero. In essence, America, I give them a free cash flow. I give them a cash flow of $5,169. Because remember, America, cash flow is the relationship between the income and the expense. And that relationship calls for a subtraction operation. So if the income is $5,169, okay, I'll reduce the expense all the way to zero. So income minus the expense, and the expense is zero, equal cash flow. So I also give them a cash flow equally as large as the income. So the cash flow would be $5,169. Because when you do 5,169 minus 0, we're still at 5,169. Okay? And how many Americans do you know? Regular Americans have $5,169 left over. Not too many. Not when we are living paycheck to paycheck. Not when we cannot come up with $400 emergency. Even after I give them this gift, which is a cash flow so large, $5,169. Okay? Which gonna bring the average daily balance to 2.2677, because we're just doing a summary of what some of the folks over Velocity Banking are doing. The number of days, they always use 30 days. which means the monthly interest charge for the cycle will be 68.03, which is going to bring it down to an effective rate of 4.1385. So the interest cost, now for having movements, let me use their terminology. They say income comes in, expenses goes out. And in this example, since we try to help them out, we reduce the expense all the way to 0. So the income was 5,169. Okay? Even after you have a movement of income and movement of expenses in the account, the monthly interest charge is 68.03. So instead of 82.37, now it becomes 68.03. 68.03, America, it's still bigger or still worse than $50, which was the saving on the mortgage. 20,000 times 3% divided by 12. Okay? So you do not want to save $50 and get charged 82.37 if you're not doing any movement, or get charged 68.03 even after movement. Okay? 68.03 in interest cost is still worse than $50. So I'm saving $50 for chunking to the mortgage or for sending a large payment to the mortgage, but I'm getting charged 68.03 even after I have movement of income, movement of expenses, even after I dump all my paycheck into the HELOC. After I dump all my paycheck into the HELOC, my monthly interest cost is 68.03, which is greater or worse than $50. Saving $50 to get charged 68.03 somewhere else doesn't make no sense. Okay? That's if they were using their formula. Okay? Because their formula uses an average. Because you know, these folks, they use this average for everything. You know, as if there is now the proper way to do it. They just use an average for everything. The 68.03 is just an average, okay, from velocity banking. But let's see how much the true one, the actual one, is going to be. Let me grab my proprietary calculator for average daily balance with compounding. Put on my password. Okay, I got my password in. 5% was the 20,000 was current balance. 5%, 20,000. Let's say we have income top of the month, because these folks are on day one, day number one. I have income of $5,169, which is kind of an overstatement, but let's say on day one, we have that 5,169, just so I could improve the numbers a little bit. So, minus $5,169 and income coming in. Okay. which will give me a monthly interest cost for the cycle of 6108. So this is proper formula. $61.08. Okay. And again, folks, it is on the HELOC, the way they arrive at the monthly interest cost for the cycle for having movements now. Remember, they use an average daily balance with compounding, including new transaction, times the periodic rate, daily periodic rate, times daily periodic rate, times the number of days in the cycle. And these folks always use 30 days. So the average would have been 14,000. Put it right here. 14,863.24. 863.24 times the daily periodic rate. Because remember, on the HELOC, they were charging 5%. So the daily periodic rate would be 5 divided by 100 divided by 365. Let's assume they were using 365 times 0.000136. Let's see, 1369863. Okay, so average daily balance times the periodic rate, daily periodic rate times the number of days in a cycle, so times 30 days. It should be this amount. Well, let's run it. 14 times 0.00136963, 14 times 30 days. Sure enough, $61.08. $61.08 for using proper formula. Okay? Because this formula that the folks over at Velocity Banking uses, they use an average. That is why the proper formula is slightly different than the average that they're using. Because again, these folks, they always use average for everything. Almost as if there's not a proper way to calculate the thing. Okay? There is a proper way to do it, America. Okay? But since they're using an average, that still counts. I'm not saying that it doesn't count. Because sometimes when you're in a hurry, I guess, you could use an average for things, okay? But the proper results, the interest cost for the month, for having movement. So you reduce that 20,000 by the income, which is 5,169. So you would have been 20,000 minus the income that comes in, 5,169. Okay, but the reason why it's different, let's run it first. Minus 5,169, you would have been 14,831. Okay? The reason why this number is different, because again, they're using an average daily balance with compounding. So with compounding, so interest got added on top of this number. So that's why this number ballooned up to 14,863 as opposed to 14,831. Okay? When you keep adding interest on top of it for the duration of the cycle, which was 30 days, so you jump from 14,831 to $14,863.24. Okay? This is when you are able, America, to find someone who could properly analyze, demystify, decode interest cost. Okay? Someone that could explain to you how they arrive at things. Okay? We're not always using average. We use actual number. Okay? But if you're in a hurry, I guess you could use average. Okay? Instead of 14,831, as far as the daily balance, average daily balance, the average daily balance is 14,863.24. Okay? So, with having movement and income coming in, it's going to go from 82.37 to 61.08. Okay? For having movement of income. Okay? That movement of income, by the way, only save you, so between those two, let's run it real quick. 82.37 minus 68.03. That movement saves you about $14.34. Okay? About that amount. Because we didn't take into account some other stuff. But 82.37 minus 68.03. Because their formula will yield 68.03. Okay? So movement doesn't cure anything at all. Movement just helps. Having $5,169, dumping all your paycheck into an HELOC only save you a little bit. Okay? But again, these folks over at Velocity Banking Group, they think this movement is like a be all and end all. No, the movement only helped just a little tiny bit. About $14.34 that you're saving. Okay? In any event, you're arriving at 68.03. 68.03 is still worse interest cost than your saving, which is $50 for chunking $20,000 to the mortgage. Okay? And that 68.03, for them, they would have an effective rate of 4.1385. So effective rate of 4.1385. 4.1385%. 4.1385% versus 3% on the mortgage. So 4.1385% on the HELOC versus 3% on the mortgage. Okay? Even after we give them free cash flow, because we reduce the expense all the way to zero. So we give them $5,169 in cash flow. Okay? I don't know any regular Americans, again, that has $5,169 per month in cash flow. Okay? Not when we're struggling paycheck, we're living paycheck to paycheck. Okay? Or even after I give them all these gifts, their effective rate got reduced from 5% to 4.1385. 4.1385, America, is still worse than 3% mortgage. So do not chunk or send a chunk payment or send a large payment of 20 grand to the mortgage. Okay? You will be going backwards. And again, 4.1385 is still bigger or worse than 3%. Okay. And again, folks, the reason why some of these folks over at Velocity Banking got you doing this nonsense is because, especially on the mortgage side, especially for the group that likes to brag about how they could help you get rid of a mortgage inside 5 to 7 years. The reason why they got you doing this nonsense because they do not know how to properly read the amortization schedule. They were going by what the interest would have been over 30 years and what the interest would ended up being after a chunk payment. One will be over 30 years, one will be over 25 years. And they're comparing the difference with just the interest cost for 1 year, which was about $1,000 if you use a simplified formula, interest cost on the HELOC. Okay? And again, folks, you have to find someone who truly enjoy numbers, someone who truly understand numbers, not just someone who just looking at numbers, can even properly decipher or properly analyze a simple amortization schedule. You can't trust these folks with your personal finance. Amateur hour, man. Blind, leading the blind. Look at the question. Please tell me why I should not send a chunk payment of $20K to the mortgage when I would be exchanging $1,000 for $25,000. They forgot that this is over a longer period. So they were comparing apples and oranges. All right, America. So sad, man. I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. Now, you have some that will tell you that I come across a video where this person was talking about that if you chunk a mortgage in the early years, even though the HELOC is at a higher interest rate, if you chunk the mortgage in the early years, you would work. Well, I've just shown you that chunking the mortgage in the early years will not work. Okay? And the reason why they were telling you that it would work was, again, because they do not know how to properly analyze the amortization schedule. Okay? Again, they were going with these figures, 30 years and 25 years. 103 minus 77, okay? America, whether it's in the early years, whether it's in the middle of years, whether it's in the later years, do not chunk or send a large payment from a 5% HELOC to a 3% mortgage, okay? So a 5% HELOC did not work, let alone if the HELOC was at 7%, let alone if the HELOC was at 10%, let alone if the HELOC was at 12%. A 5% HELOC would not even work. Okay? Let alone if it was a credit card at 18% or a credit card at 29%. Okay? Folks, a 5% HELOC would not work So do not attack a mortgage, whether it's with a 5% HELOC, whether it's with a 7% HELOC, a 10% HELOC, or 12% HELOC. Okay? Do not attack a mortgage that is at 3% with an 18% credit card or a 29% credit card. Okay? These folks, some of them don't understand how interest rate works. Okay? Some of them cannot read the amortization schedule. America, over at Ambroise Method, we are specialists when it comes to paying off debt. So much so, America, by the grace of God, we were able to devise not one, but two different type of users. We have Ambroise for Ambroise Method. We have what we call a normal user. And we have what we call an advanced user. America, which debt repayment method do you know offer you two separate users? Offered you so many options. Normal user, advanced user. Two different users. Okay? Why? Because we mastered this thing called paying off debt. That's how we were able to offer you more options. And again, for a normal user takes advantage of transfer. A normal user takes advantage of cash flow. And for an advanced user on our method, not only will take advantage of transfer, that's when you transfer funds from one account to another, or you relocating balances from one account to another. An advanced user uses alternative accounts. And an advanced user uses cash flow. Okay. The reason why I wanted to give you guys so many options is because I know that this alternative account could be a problem. So one includes alternative account, the other exclude alternative account. So transfer cash flow, and alternative account. Okay? Because this alternative account could be a dangerous account if you don't know what you're doing. Just like some of the folks over at Velocity Banking Group, they don't know what they're doing. You see what kind of chaos this alternative account, ended up being or causing. Okay? They're going backwards, not even knowing that they were going backwards. Why? Because they don't fully understand, some of them, or all of them, but let's just say some of them, they don't fully understand this alternative account. Okay? They refer to that as debt weapon or debt tool on their end. Okay? So now while you're learning about this debt weapon or debt tool, if you belong to the other group, alternative account for us, while you're learning about that, you have the options to be a normal user. Just take advantage of transfer. Just take advantage of cash flow. That's all you need to do. Okay? The only time you take advantage of the alternative account is when you actually master it. Because again, this alternative account, America, is a very dangerous account. Okay? And we proved that earlier with all this nonsense that the other groups are doing because they don't fully understand that account. Okay? They don't know how to properly use that account. Okay? So be careful. If you don't know what you're doing, just be an Ambroise Method normal user. Okay? All right, America, I'll give you about 5-10 seconds to take a look at what's on the board, and then we're going to continue with the exercise. All right, America. So, where that snowball might have failed you, America, we will not fail you over at Ambroise Method. America, where that avalanche might have failed you, we will not fail you over at Ambroise Method. America, where velocity banking group might have failed you in the past, we will not fail you over at Ambroise Method. Okay? Again, folks, my name is James Ambroise. I am the author, creator of Ambroise Method 1.0 and Ambroise Method 2.0. Ambroise Method is a revolutionary debt repayment method that offers greater results in terms of reducing interest cost compared to debt snowball, debt avalanche, velocity banking. Thank you, Jesus. Until next time, America. Good morning.